Good morning or good afternoon, everybody. It's about 12 o'clock on Monday, the 21st of December. And I want to discuss about the hourly and things what happened so this week. Just got a little tone. Usually this week tends to be a higher market week. I call it a feel-good rally in the market. And this is the hourly E-mini S&P. It's really a classical wyckoff chart. And I waited today. You have 2 days to trade this. This is classical absorption, vertical absorption, and accumulation. Here's the accumulation. We would add a position, or you position out. Here's the edge position right here in the market. Right here's the edge buy. It's a small penetration buy in the market right here. You see how beautifully it is, but part of the absorption process on the right-hand side is the high-end closes and the strength in the backgrounds. So you have strength in the backgrounds. It goes all the way to here. It goes all the way to the backgrounds. You draw that line across, and you get the retest here, perfect retest. The trade that you'd want to initially put on is right here. Is a spring that occurs after strength. The spring that occurs after strength. This is the place your first edge to buy. Spring after demand. Edge buy. First one right there. Market goes up. Doesn't have to be. This is really just sideways. Lack of supply. This is okay. You got spring here, edge to buy, spring here, and you're long. And you have vertical absorption, and this takes you to around probably the 70 even. You could do it this week. You're 69.34 right now. You could have a target basically that goes up to here this week. Okay, it's got 3 days total to do it. Not really a big deal to do it, right? 7,000 makes it good, makes your turkey go down good, makes your ham go down good. You know, target is 7 even. It's this beautiful vertical absorption. This is a sideways trend range. It develops cause. Sideways trend was cause. And you get the to go higher to the upside. Okay, so that is something where the market just gets to the level in which it's up sideways trade range, tight trade range. It leaves the trade range. This is my one of the seminars. What series rather? High-end closes. You leave it. Leaves a retest. Buy. Boom. Perfect illustration of demand background and absorption in the buying springs to buy. 60 minutes, 60-minute gold. We'll do this real briefly because the markets are so strong and so pronounced and so easy in the sense of what's happening. Never easy to trade them, but always, sometimes from a wyckoff standpoint, they become very clear about what's going on. I now take the COMEX gold futures. It's very similar in nature as far as that goes. You have some selling that comes to the market. I'm gonna put this over here like this. The other market. Here's a reaction high. So the reaction high. Here, right? Reaction high. And it's the reaction high. And here we have on the right-hand side, look at the perfect vertical absorption. This is vertical absorption. High-end closes to the market. And it doesn't get better than this at all. The retest here is on light volume, comes right to here. It's an edge. Boom. Okay, we'll mark that a little more definitively for you. Markets here. The reaction high also comes down to here. The market. So you have market strength, grinding strength, right? Retest right here, boom. You have add vertical absorption going higher. Taking the market currently the gold here, nothing but vertical absorption. Every time the market gets to see some selling, the market gets immediately bought. And this is more strength in the market. Anytime the market was retest back to 44.51 support area, the 44.70, 44.73 last. You can see the market, also giving up to at this point probably 4,500, 4,500. It's not higher. So both markets are absorption. Both we watch springs. Very easy reads. Sometimes they're easy as far as that goes to look at, but not necessarily. People get scared. But these are the best trade markets to trade. Because usually you have a lot of volatility over the next month or so. So you get involved in these things. Buying a spring on a 60-minute chart or buying a spring on a gold 60-minute chart, there's not many things that are much better from the standpoint of risk-reward ratio in the market. Because the 60-minute chart, you can trade intraday and make your money. You buy the daily prices, and they go sideways. If you buy this stuff on a daily basis, on a 60-minute chart, you got about 5 or 6 bars to make your profitability if the market marks up. So, like even today, I look at the market marking up today, and we're 4 hours into the market. So, buying springs and buying, areas that are support areas, SOTs and springs and effort result bars in markets that show strength in the background, buy them. As long as you don't get supply, there's a shakeout. Continue to buy the breaks in the Gold and S&P on these little springs. Eventually, you're going to have a losing trade, by doing that because the market will reverse. But at least hopefully the most part, you bought the ones earlier, they were correct and made money. So as far as that goes, it's really important to realize that it's not going. It's easy reads. Never easy to trade. When you have to put in the fire, it's still a big deal. But at this point, it looks like the market definitely is at a point where we should at least head to the upside, and we should get to the point to where we should get a situation to where the market acts well, and we should see more upside, especially this week in the market. Thank you, and everyone have a great day. We're going to see you guys tomorrow. Bye, everybody.